Well, it's great to see everybody in a good mood here for 2024. I call this meeting to order and welcome the governor and the senior deputy governor. We're resuming meeting number 124 of the House of Commons Standing Committee on Finance, and pursuant to Standing Order 108 Bracket 2 and the motion adopted by the committee on Tuesday, January 30th, 2024, the committee is meeting to discuss the report of the Bank of Canada on monetary policy. Today's meeting is taking place in a hybrid format pursuant to Standing Orders 15.1. Members are attending in person in the room and remotely using the Zoom application. All those that are attending and in person or virtually, we have gone through the health and safety remarks, so I will come to the point where we are going to welcome the governor. We welcome Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers for their opening remarks, and then for members' questions. Welcome.
Well, thank you and good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss our monetary policy report that we published last week, as well as the decision we took. Last week, we maintained our policy interest rate at 5%. We are also continuing our policy of quantitative tightening. Our message is twofold. First, monetary policy is working to relieve price pressures, and we need to stay the course. Inflation is coming down as higher interest rates restrain demand in the economy, but inflation is still too high, and underlying inflationary pressures persist. We need to give these higher interest rates time to do their work. Second, with overall demand in the economy no longer running ahead of supply, Governing Council's discussion of monetary policy is shifting from whether our policy rate is restrictive enough to restore price stability to how long it needs to stay at the current level. So let me give you some economic context for these considerations and talk about the implications for monetary policy. Economic growth stalled in the middle of 2023. For many Canadians, the combination of higher prices and higher interest rates has been difficult. But past interest rate increases have helped the economy rebalance, and this is relieving price pressures. Lower energy prices and improvements in global supply chains have also helped to bring inflation down. Growth is expected to remain flat in the near term. With weak demand in the economy, upward pressure on prices should continue to moderate, and inflation is expected to ease further. The share of CPI components that are rising faster than 3% has declined substantially and should continue to normalize. But tightness in some parts of the economy is continuing to hold inflation up. The most prominent of these is housing. Inflation in shelter services remains high, close to 7%, because of rising mortgage interest costs, higher rents, and other housing costs. And while food prices are not increasing as fast as they were, food price inflation is still about 5%. Finally, inflation in services excluding shelter has improved, but there are signs that price pressures remain. All this push and pull on inflation means that further declines in inflation will likely be gradual and uneven. That suggests the path back to 2% inflation will be slow and risks remain. Dans l'ensemble, nos prévisions de croissance.
Overall, our outlook for both growth and inflation is largely unchanged from when we were here in October. Economic growth is expected to be modest in 2024, weak in the first half, before picking up around the middle of the year and rising to about 2.5% in 2025. With downward and upward forces largely offsetting in the near term, CPI inflation is expected to remain close to 3% over the first half of this year. It is then expected to ease to about 2.5% by year end and return to target in 2025. Let me give you a sense of Governing Council's monetary policy deliberations. At our decision last week, there was a clear consensus to maintain our policy rate at 5%. We also discussed where we see the economy and inflation going and what that could mean for monetary policy going forward. What came through in the deliberations is that Governing Council's discussion about future policy is shifting from whether monetary policy is restrictive enough to how long to maintain the current restrictive stance. If the situation changes, we may have to raise the rates. But if new developments push inflation higher, we may still, I expect future discussions will be about how long we maintain the policy rate at 5%. Governing Council is concerned about the persistence of underlying inflation. We want to see inflationary pressures continue to ease and clear downward momentum in underlying inflation.
The risks to the economy and inflation. We're trying to balance the risks of over and under tightening. We don't want to cool the economy more than necessary, but we don't want Canadians to have to continue to live with elevated inflation either. We remain focused on a number of indicators of underlying inflationary pressures. We need to see further sustained easing of core inflation. With the economy now looking to be in modest excess supply, demand pressures have abated. Corporate pricing behavior has continued to normalize. At the same time, measures of near-term inflation expectations and wage growth suggest that underlying inflationary pressures remain. So let me conclude. We've come a long way from the inflation peak in 2022. Monetary policy is working, and we need to continue to let it work. We remain resolute in our commitment to return inflation to the 2% target. And with that summary, Chair, we would be pleased to take your questions.
Well, thank you, Governor, for your opening remarks, and thank you for coming before Finance Committee first time in 2024. I know the members have many questions. Members, I know there are certain subjects that you want to get into with the Governor. They may need more fulsome answer time, so I will be quite lenient in terms of the timings, so to be able to provide that ability for the Governor to answer and the members also to pose their questions. So on that, we're going to go to MP Hallen, please, as our first questioner.
Thank you, Chair, and thank you once again, Governor, Deputy Governor, for being here. Unlike the Finance Minister, making yourself so accessible to this committee. Governor, my question is, a few short months ago, in this committee, you had said that the government's fiscal policy and your monetary policy were rowing in opposite directions. Was that still a factor when you made your decision last week to hold rates?
Well, with respect to fiscal policy, we take the budget plans of all levels of government. We build those into our forecast, and you can see those in our monetary policy report. So yes, we did factor in government spending plans. That is contributing to growth in the economy, and that is something we factored into our decision.
Thank you. And more specifically, because I'm really interested in those factors that you talked about, was it new expenditures, just the level of growth, or was it cumulative of everything from before? What were some of those specific factors that you looked at?
Well, let me maybe talk about what we see. First of all, let me just back up for a second. As I've said many times, fiscal policy decisions are not the purview of the Bank of Canada.
Fair.
They're taken by parliamentarians. What we do is we take the spending plans as government has given, we build those into our outlook. If you look at the spending, if you look at spending in 2023, all levels of government, real government spending on goods and services, it grew at about 2%, which is roughly in line with the growth of potential, most of which is population growth. If you look ahead to the next year, based on published plans, we estimate that government spending will be growing around 2.25%. So it's still roughly in line with potential, a little bit on the high side.
Yeah, sorry, just because I have a limited time, I appreciate the explanation. What I wanted to get to was, if those are obviously pressures on you or a part of a bigger picture of you, when you look at lowering rates or keeping them the same, if those same pressures in what you said was fiscal and monetary policy working against each other right now. If those pressures were eased by a lower deficit, spending by the government, would that help factor lowering the rates?
So I was actually getting to the go-forward strategy. So with government spending growing, estimated to be growing around 2.25%, it's a little above potential. We built that into our forecast. You can see inflation comes down gradually in our forecast. Having said that, it's already at the upper end of potential. So if governments were to add more spending, it could start to get in the way of getting inflation back, and that would not be helpful.
Definitely. And so there was just recently a report in the Globe and Mail about expenditures, and we know that in the fall economic statement, the growth is already at 3.2% according to the government. Also, we know that from April to November of last year, there is an increase from the previous year before by almost $15 billion in expenditures or a deficit. Are those being considered as well? And if those pressures were not as much as they are, would it help lower the ceiling that you're talking about when you're looking at those pressures that are pushing up inflation?
So anything that has been announced by the government and has been through the House, yes, that will be built into our projections.
But the actual expenditures are increasing. Would you have to reforecast?
So when we get the national accounts data, we do update our forecasts. So when we get Q4, we will be updating our forecasts.
And specifically in the report, it's clear that the shelter inflation or shelter costs are keeping it high. The CPI is high, and it has the most growth inside of inflation. What specifically is driving that?
Actually, do you want to say a few words about that?
Sure. There's a number of things inside shelter inflation. Obviously, mortgage insurance cost is part of what's keeping overall shelter inflation up. Normally, what you would have seen in past tightening cycles, as interest rates go up, you would see a decline in house prices. But because we have sort of a chronic structural shortage of housing in Canada, we haven't seen that sort of offset that adjustment. So housing prices are still part of the overall higher shelter contribution to inflation. Rents have also risen quite a bit recently.
Is that because of the demand?
Sure. I mean, prices go up when there's more demand than supply, and right now there's more demand than supply for rental housing in Canada.
I'm sorry to cut you off. It's just because I only have a few seconds left, I believe. I wanted to move on to another topic. In your presser, you talked about how there's high inflation. It's been high for more than 2 years now. We know that the economy is stagnant, and it's almost going to be a year that it's going to stay that way, even according to the government's own projections. We also see unemployment ticking up. Is that a stagnation, a stagflation risk? Is that something you're worried about?
I wouldn't call it stagflation. Growth is weak, and in fact, we actually need this period of weak growth.
Sorry, let me clarify that if that trend continues, is there a fear of some form of stagflation if unemployment continues to rise? And given everything else is the same, because those are literally the definitions of
well, I mean,
stagflation
is a period of high inflation
and
high unemployment. We don't have high unemployment. Yes, unemployment has come up, but it was extremely low. It's back to more normal levels.
But it is upticking now.
It is ticking up, and actually, I expect it will go up a little bit more.
I'm just saying this because the chief economist.
So we will go over time. So to MP Baker now, please.
So Governor and Senior Deputy Governor, thank you for being here again at the Finance Committee. I'd like to start along the same lines, Governor, as what you were discussing with my colleague about government spending plans and their impact on inflation. In the following the government's presentation of the fall economic statement, so the mini budget, if you will, of the government that's issued, presented every fall, you said the FEZ is, and I'm going to quote what you said, not adding new or additional inflationary pressures over the next couple of years which is the critical period over which we'll be looking to reduce inflation and getting back to target. So can you expand on that? I mean, I just want to make sure folks at home are very, very clear. You know, is the latest fall economic statement, which is the latest spending plan of the government, adding undue inflationary pressures to the Canadian economy?
So what I was referring to in that quote is relative to the track that government had laid out previously. The fall economic statement didn't add new spending, material new spending that would add new inflationary pressures. We have built the previous budget as well as the fall economic statement into our projection. As I mentioned in the previous answer, that gives you for next year growth in government spending at all levels. Obviously, the provinces are a big part of this, of roughly 2.25%.
So am I hearing you say that if growth in spending is around 2 to 2.25%, and you referenced that earlier in your earlier response, that's a level at which government spending is not unduly contributing to inflation?
So if it's in the range of 2%, the economy is growing roughly 2%. Most of it, population growth is roughly 2%. So it's growing in line with the size of the economy, and in that sense, it's not helping to get rid of inflation, but it's not contributing new inflationary pressures. As I underlined, at 2.25, it's at the upper end of that. So if there was new spending initiatives, either federal, provincial, it could start to make it more difficult to get inflation down. It could start adding new inflationary pressures.
Okay. You mentioned a moment ago that when you looked at the government spending plans that were in that fall economic statement or in the government's budget, that you saw government spending growing at 2%, if I understood you correctly, this year, and then 2.25% the next year. Sorry, go ahead.
Last year, we don't actually have all the data for last year yet.
Okay.
So it was roughly 2% last year, 2.25% this year.
Forgive me. Thank you. So 2% last year, 2.25% this year. So the data you have says government spending grew at 2% last year, is planned to grow at 2.25% next year, or this coming year, I'm sorry. And so what I'm hearing you say is as long as spending growth is close to that 2% target, and you've called the 2.25% growth close to the upper range of that, that it's growing more or less in line with population growth, so it's not unduly contributing further to inflation. Is that a fair characterization of what you're saying?
Yes.
Okay, thank you for that, Governor. What I'd like to do is ask you something that my constituents ask me all the time. And I promised several of them that the next time you came to Finance Committee, I would ask you. And so what many of them are struggling with is their mortgage costs. Many of them, especially those who already have mortgages, have been renewing their mortgages at much higher rates than they've had in the past. Some of them are approaching that point where they have to renew their mortgages and are really concerned about their ability to service those mortgages, to get approved for those mortgages, and frankly, to keep their homes in many cases. So I think the question I get asked all the time, Governor, is when will interest rates come down? And I know you can't give us a specific date, but what would you say to my constituents who are watching at home, who are asking, when is the Bank of Canada governor going to bring rates down?
Well, look, the first thing I'd like to say to all Canadians is we know Canadians want to see inflation come down. We know they're tired of seeing prices go up so quickly, and we know they'd like to see interest rates come down. And so would we. When we have more assurance that in those inflation pressures are easing and inflation is clearly headed back to 2% inflation, we can have that discussion about cutting interest rates. But right now, monetary policy is working, and we need to let it keep working. If I can just expand a little bit, when we were here last October, I got a very similar question. And at that what's happened since October? Well, what's happened since October is, the data we've seen with the economy, what we've heard from households, what we've heard from businesses in Canada, has made us more confident that interest rates are now high enough to get inflation back to 2%, our 2% target. That doesn't mean that, we might, that doesn't mean that, if new things happen, we may still have to raise interest rates. But what it does mean, if you take all the data we've got, you take our outlook, it's suggesting that interest rates are high enough to get us back to the inflation target. The question is, your question is, when can we cut them? And, we can't put it on a calendar. That would, well, we need to see how inflation evolves. We've seen this kind of push and pull in inflation, and we've talked about housing. That's boosting inflationary pressures. More broadly, we are seeing inflationary pressures come out. We need to see how that evolves, and when we see those easing further, when we see sustained downward momentum in underlying inflation, we can have that discussion. I hope that comes sooner than later. But we're going to have to see how inflation evolves.
Baker, and now to MP Samari, please.
Monsieur le Président, Madame.
Thank you, Madam Chair. Mr. Rogers, Mr. Mickey. So my first preamble is probably going to be fairly long. Just as you, we see the importance of bringing inflation back to between 1 and 3 to 2%. For its impact on inequality. Your restrictive policy is having a deleterious effect on the housing sector. Ms. Rogers, you reminded us that there's a chronic shortage of housing. And when we look at the last year in Quebec, we saw a drop in 70% in new housing starts. The policy interest rate is a bazooka, and it can have non-desired effects. So, for example, with regard to the housing sector. So I'm thinking of renters, for example. If the owner comes to renew their lease at a higher rate, there are no... Given competition, the bill gets passed on to the renter. Now, as politicians, we are all very concerned by this type of thing. So where I have a question for you is as the use of the policy interest rate as your main tool. What other tools are available to you to bring inflation down, and that wouldn't have as large an impact and as negative an impact as a key interest rate? So have you been thinking about these things? Are you doing research on other tools and what is done elsewhere in the world that could allow us to fight inflation? Yes, but also to support the construction of housing, for example. Thank you. Well, a short answer is that our key interest rate is our primary tool to bring interest rates down. I don't know how to say, it's a blunt instrument, and it has an impact on everyone. We can't target different parties. So in one way, it makes monetary policy more difficult. But in another way, it's the reason why a monetary policy is effective. It affects all the economy, it affects all businesses. So it has a foreseeable impact on demand and a foreseeable impact on inflation. Now, with regard to other tools, though, this is up to you to decide. Governments can implement measures, taxes, grants, other budgetary measures that can target the various sectors of the economy. So at the Bank of Canada, we're happy to see all levels of government, municipal, provincial, federal, working together, working more together to try to use different mechanisms to reduce shortage in the housing sector. Now, it'll take some time. But our high interest rates have lowered demand, but there's still a supply issue in the sector. In terms of supply, what's needed is different measures from different levels of government. All right. Well, maybe a second question then, a follow-up question. As an elected member, when I see that we have inflation at about 3%, which is above 2%, it's not ideal, but when I see the shortage of housing and homelessness and the drop, 60% drop in housing starts because of the high interest rates, as the initial impact, I think that it might have been better to slow down on fighting inflation and to provide support for housing. So just to clarify, so your interest is in, well, it's important for us to understand the shortage of housing, but we just don't have the tools to deal with it. And what I'd like to point out is this. High interest rates have an impact on the housing sector, but the effect is bigger on the demand side than on the supply side. So yes, there is an impact on the supply side. Developers have pointed that out. But when we look at the sector as a whole, the impact on demand is much stronger than on the supply side. Now, in recent years, demand was much higher than supply. And by increasing the interest rate, we reduce the demand. And so the economy is much more balanced now. But because of a long period of lack of demand, there's still a shortage. All right. Thank you. I will have other questions the next time my turn comes around.
Sure. I actually want to pick up pretty much where that conversation left off. I do think it's important to say that when we talk about balancing supply and demand in the housing market, while demand on paper has gone down, there aren't less people in Canada who need a place to live. So, demand for housing is completely inelastic. There's just as much demand for housing as there ever was. There's just more people living on the street who aren't bidding on houses because it's completely outside their financial possibility. And so I think it is important for us to recall as policymakers that in fact the demand for housing is equal to the number of people that live in Canada. The question of how many people are bidding on houses matters. I'm not saying that isn't an important metric, but when we bring those two things into alignment so that there's roughly about a good number of people bidding on houses for the amount of supply, doesn't mean that demand has gone down. It means that people are just displaced out of the market, and they're the people that we're seeing live in encampments in our cities and on the streets and everywhere else. And so I think it's important for us just to bear in mind that we're not really talking about a balancing of demand and supply. We're talking about demand segments disappearing off the ledger and living on the street. One of the things that I think Canadians have really been challenged with when it comes to housing, if we think about before interest rates went up, low interest rates, certainly there was a school of thought that would say low interest rates were raising the sticker price of houses, and so in that sense contributing to housing inflation. Since interest rates have gone up, people have really been feeling the pinch because even though the sticker price may be coming down, their ongoing operating costs of owning a home and servicing the mortgage have also been an important driver of inflation. Now, as we talk about a period on the horizon, albeit not sure when that's coming exactly, where interest rates will go down. Are you concerned that that means housing will continue to drive inflation because as people can borrow more money with the same income, we'll go back to the race that was on before interest rates went up, where sticker prices are quickly escalating, also driving people out of the housing market?
Well, I think you've described actually the difficulty in the housing market quite well. Exactly as you described, when interest rates were very low, demand for housing was very strong. We saw a large appreciation of house prices. As you're well aware, house prices through COVID went up more than 50% over 2 years. That wasn't all interest rates. Part of it was people wanted more space during COVID, but interest rates were certainly a part of that. And that actually pushed up a shelter price inflation. Shelter price inflation has actually been quite high for several years. What's changed with the increase in interest rates is the composition. It was largely because the house prices were going up a lot before. Mortgage interest cost was very low. Now mortgage interest cost is high, but house prices are not going up very much. They came down a little bit and they've kind of stabilized. They're going up slowly. So I think also to get a little bit back to Mr. St. Marie's question, I think what this highlights is you're not going to solve housing with low interest rates and you're not going to solve it with high interest rates. We've tried both. And we've had high shelter price inflation. And it comes back to, the durable solution is to increase the supply. And that includes both supply of homes and the supply of purpose-built rental.
Do you think that it's something government should be contemplated? And of course, if you have any suggestions, we're very happy to hear them. But even in a general sense, if government has a sense that at some point interest rates are going to begin to come down, is there a set of policy tools that, is there a difference in terms of what policy tools might help with rapid kind of sticker price inflation in housing versus the inflation that we've seen over the last number of years where interest rates have been higher? Is there a different kind of toolbox that government should be looking to as they prepare for a potential change in direction of the bank? Are there tools that make more sense now given the nature of the problem that we're facing around renewals versus how do I get enough to bid on a new home?
Well, we're not experts in housing policy, but I think the message is it's policies that are focused on supply are going to help fix the situation. Policies that are focused more on demand are simply going to make the situation worse because prices will just start going up, making houses less affordable. It's really very much policies that are focused on supply, and that does require an unusual level of cooperation between the municipal, provincial, and federal governments because the instruments on supply are spread out across different levels of government.
So something like a first home buyer's savings account or something like that would be an example of a demand side measure, whereas recapitalizing the co-investment fund, which has been important to be able to build various kinds of non-market housing across the country, would be an example of a supply side measure. Is that kind of a fair?
I think that's reasonable.
Okay. Thank you very much. I don't know how much time I have.
6 minutes, so we're finished with this round.
Okay.
Thank you,
I had a
MP
feeling
Blakey.
I might
Yep,
have used
yeah,
my
that's
time.
very good, right on time. So listen, members, we are moving into the second round. It's less time, but it's 5 minutes for MP Lawrence, please, with the governor.
Thank you very much, and once again, thank you, Governor Macklin, for coming here. I think it's a credit to you and to your institution that you're as president as you are. My questions will start with GDP and GDP per capita, and I think to my mind, it's almost getting to the point of a myth of a soft landing, because although our GDP as a whole, as an aggregate, doesn't look terrible, our GDP per capita does. Q3 2022 -1, Q4 2022 -3.3, Q1 2023 minus 0.6, Q2 2023. And so while our GDP as an aggregate has showed modest growth, GDP per capita, which I believe is a better accurate measure of how Canadians are actually dealing with the economy, is showing we are in a very difficult time. To quote the leader of the NDP, it's bad. It's very bad. Your comments on that there?
Oh,
Do you agree?
My comments. Well, there's no question we have seen weakness in consumption. And on a per household, per capita basis, yes, we've actually seen declines in the level of consumption. At an aggregate level, that's being offset because there's more people in the economy. So on average, in aggregate level, growth has been roughly flat. But yes, I agree. It is difficult for Canadians. They're feeling the effects of higher prices. They're feeling the effects of higher interest rates, and we can see how that's affecting their spending. It's particularly affecting their spending on durable goods. They've been cutting back on services. They've been cutting back on non-durables, and that's showing up in the weakness in per capita consumption.
And this is all in the context of over the last 10 years, in the United States, the GDP per capita has grown by 47%. In Canada, it's grown by 4.7%. We are in one of the worst economic times since the Great Depression. And so I just want you, and I know you've spoken eloquently about this, but the impact particularly on the vulnerable of keeping interest rates high and driving per capita GDP even further into the basement has real life consequences. We see 2 million people a month going to the food bank. I know that you know this, but I think it bears repeating of the pain that are being inflicted on Canadians right now because of the high interest rate and this government's reckless fiscal policy.
Look, nothing worries us more than, we know inflation is affecting the most vulnerable Canadians the worst. Food price inflation is high. You can't really economize on your purchases of necessities. They're necessities. And so, yes, this is hurting. And the best way to solve that problem is to get inflation down. And we've made a lot of progress. We need to finish the job.
If I can, just wanted to clarify with the discussion you had with both my colleague MP Baker and MP Halon. I think you used the threshold of 2.25 spending growth rate. Anything above that in the upcoming budget will be unhelpful for your fight against inflation. Is that correct?
If government spending is growing materially above, government spending, all levels of government, if real government spending at all levels of government is growing materially above 2%, that will make it more difficult to get inflation back to 2%.
And then I want to return to a conversation we've had at numerous meetings with respect to the carbon tax. And I want to thank you for your candor at the last meeting of saying that the carbon tax was adding 0.6%. There's been a little bit of a mischaracterization, I think, of some of your comments, once again, Governor Macklem, when you said that there would be, it's a one-time or one-off impact. When the reality is, as will happen on April 1st, the carbon tax will increase. And it's scheduled to increase all the way up to 2030. And so presumably, if in our parlance we axe the tax, not only would you eliminate it one time off, but there's also the upcoming increase, which is scheduled to be in the range of 23%. And I think you've said it at other committee meetings that it was about 0.1% every increase. And could you confirm that if we eliminated the tax and, of course, presumably, the increases to that tax, we would have an ongoing impact which would reduce inflation?
Yes, I think you summarized the numbers. So, as you said, there are planned increases in the carbon tax going forward. The direct impact of that on the three fuel components would have an impact of about 0.15% each year going forward on the CPI. If you eliminate the tax, you'll get a one-time 0.6% decrease in inflation. The next year, that'll go it'll go back to where it was because you can only eliminate it once. But yes, I see your point. You're also eliminating the future increases.
And now to MP Zarowitz, who's coming to us virtually.
Hello. Thank you so much, Governor, and thank you so much, Senior Deputy Governor, for joining us today. I'm going to start off very quickly on the fall economic statement. We had included some new fiscal guardrails, and I believe that you were quoted as saying they were helpful from the perspective of monetary policy. Can you elaborate on this?
Yes. So your new fiscal guardrails, I think what is helpful about them is they assign a number and they also assign a date. And so what that does is it provides some limits on how much spending can increase going forward. And in that respect, I do think they're helpful.
And so, Governor, sorry to interrupt, but I should have clarified this. I think a key one of our sort of new commitment was to our goal of keeping deficits below 1% of GDP beginning in 2026, 2027, just for the public to be reminded.
That's exactly what I was talking about. And what's important about that is you have a goal, less than 1%, and you also have a date on it. So that going forward, in order to respect that target, you won't be able to increase spending substantially.
Thank you. My next question is around wages and productivity. It's a question I often ask you about. Wages, we know, have been going up. And I think you have been articulating that you don't see and wages going up, you have indicated is not a problem if productivity also increases. But I believe what's happening is wages have been going up, which I've been happy to see because I think they've been stagnating for too long. But you've been articulating that productivity has not been going up. And I guess my question to you is, how is it that, and you might, I hope you have an answer to it, how is it that productivity can be increased if without increasing business investment, which interest rates is actually trying to discourage right now? So I wonder whether you have, I'm not sure if you have policy prescriptives, but I guess if you could answer the question, how is it that the productivity could be improved if what monetary policy is trying to do is discourage business investment?
I'm going to ask Senior Deputy Governor to talk to
thank you.
productivity.
Thanks for that question. I mean, the reason that we watch closely the relationship between wages and productivity is that, if wages continue above productivity for a while, what will eventually happen is companies will feel the pressure to build the higher wages into their prices, so you can get what we call a wage price spiral. What we have seen more recently is we think most of the wage pickup we're seeing right now is really a catch-up. People have seen their cost of living going up. They're asking for higher wages. That's completely reasonable. But as you point out, if wages run at a pace above productivity for a while, then we worry. So what can be done? I don't know that we're necessarily discouraging business investment. Business investment that goes into increased productivity will always, over the long term, help the economy grow without producing inflation. Businesses can make capital investment. They can invest in their employees. They can provide training. There's other ways to increase productivity. You can remove trade barriers. So there's more than one way to make the economy more productive than just business investment.
Okay, thank you. That's very helpful. And I want to go back to housing since it's top of mind for all of us, and rightly so. This is, if you ask any resident of any of our ridings, they would indicate that is the top issue for them, in addition to just other affordability type costs. Senior Deputy Governor, I think you were talking earlier about that there needs to be an increase in the supply of housing. I think it was both you and the governor who had indicated of that. We've been doing a study around inflation and housing. We've also heard of other things that have really contributed to the housing issue we have now. So lack of rent control, so vacancy rent controls, long wait times for approvals and funding at all levels of government, as well as dysfunction of things like landlord and tenant boards. And so I wonder whether you would agree that in addition to the fact that we need to be building more supplies, there's also other issues that need to be worked on at all three levels that would be helpful in addressing the housing needs that we have now.
I mean, I think that's exactly the point the governor made a few minutes ago, that the one thing about housing is that the type of increase in supply that we need is going to require cooperation across all levels of government, because the levers exist at different levels of government. So these are not areas of policy that are our expertise, but certainly we would very much like to see the supply issues addressed, and any effort that's across those multiple levels of government is welcome.
Thank you,
so much.
And thank you, MP Zerowitz. MP Sainte-Marie, please.
Merci. Je vais vous...
Thank you. I'm going to ask my two questions at the same time, given the short amount of time we have left. So, Mr. McLem, you talked about resilience of supply chains in your opening statement. Now I'd like to have your opinion or your analysis on the events in the Red Sea and in Panama, where the number of passages are being limited. What impact do these things have potentially on the inflation rate, and how is the bank taking that into account? Second question, in your report, you said the risk premium with regard to oil has reduced, and that the war in Israel is having an impact. So I would ask you to provide a bit more detail on that. All right. At the end of our report on monetary policy, we pointed out that there are some risks with regard to our forecasts. There are risks, higher risks and lower risks. So one of the higher risks is the war between Israel and Gaza, and also the attacks on boats and vessels in the Red Sea, and the fact that there's not enough water in the Panama Canal. So at this point, we haven't seen major impacts from those events, but if that starts happening, if these things last a lot longer, if things take a turn for the worse, then that can have an impact. The war can have an impact if other countries start participating in the war. We could see a stark increase in the price of oil, and that can have a very fast and very direct impact on inflation. And that will also have an impact on transportation costs and supply chains. So in the Panama Canal, so that can impact the price of it can have an impact on the price of goods, essentially. So at this point, though, we haven't seen any. Now, as for your second question, since the beginning of the war between Gaza and Israel, oil prices have gone down by about $10. And in recent weeks, the prices have been rather stable. So when we changed our forecasts, or when we revised our forecasts, we hypothesized that the price of oil would go down by 10% with regard, or compared to the prices in October. Right. Thank you.
Very much. I know in an earlier comment you were saying that you would like to be in a position to bring down interest rates, and I think again with the with a potential lowering at some point on the horizon. Kind of raises the question, I know that the bank, has an inflation target, but is there something that you consider to be an ideal interest rate? And, as you think about this moving forward, and we know that there are many, there are a lot of reasons for why we've experienced inflation. Some of them are under government's control, others aren't. And we know that difficult economic times are certainly possible, if not likely, in the years and decades to come. So, one of the tools that the bank has sometimes used in times of slower economic activity has been to reduce rates in order to stimulate economic activity. So at what point do you get concerned that that's not a tool in the toolbox if interest rates are too low? And do you have an idea of where you want to land in terms of an interest rate amount in the short or medium term?
I'm not sure I fully understood your question, so stop me if I'm. So, look, we don't have a target for the interest rate. We have a target for inflation. The ideal interest rate is the one that gets us to 2% inflation. What that's going to be, though, because the interest rate is the instrument, what that interest rate is going to be that gets us to low, stable inflation is going to depend on what happens in the economy. We do very much worry about the risks on both sides. So, inflation's been too high. We've taken forceful action. We've raised our interest rates. We are committed to getting inflation all the way back to 2%. And so we want to make sure that we do enough, and we don't want to sort of drop rates prematurely, realize that we're not going to get back to 2% inflation, and then have to raise them again in the future. On the other hand, we don't want to leave them high for so long that the economy cools a lot more than it needs to, and inflation actually in that case would probably fall below our target. So it is a difficult judgment. We spend a lot of our time discussing, are we doing too much? Are we doing too little? How much more do we have to do? So that is really the center of our deliberations.
So does that mean, if I'm hearing your answer right, that the bank wouldn't really consider a lowering of the interest rate until you felt that there was a risk of deflationary pressure? Or if inflation returns to target and is forecast to be on target for the foreseeable future, would you entertain a lowering of the interest rate, or does that begin to take into consideration factors outside of the simple rate of inflation?
Well, as inflation moves towards the target, we shouldn't need interest rates as restrictive as they are, because they will have done their work and we're getting there. So in terms of how we think about it, as I've stressed a number of times, there are lags in the effects of monetary policy. What we do now affects the economy over the next year and a half. So we don't want to wait until inflation's all the way back to 2 before we start cutting interest rates. Because if we did that, we would overshoot. We'd go below 2% inflation. We'd cool the economy more than we have to. So, yes, you do want to start lowering interest rates before you're all the way back. But you don't want to lower them until you're convinced, you're assured that you're really on a path to get there. And that's where we are right now. We're looking for that insurance. It's working. We don't think we need to raise rates further. Okay. But we need to let it work. And when we see that assurance,
really let him go.
We'll have that
Listen, hands off here. Thank you, MP Blakey, Governor, and now to MP Morantz, please.
Thank you, Mr. Chair, and thank you, Governor, Deputy Governor. We always appreciate your being here, and very much how transparent the bank is being with Canadians during these difficult times. I wanted to start off by asking you, I went back and had a look at the January 2023 monetary policy report. And in there you said CPI inflation is forecast to decline and to reach the 2% target in 2024. Today you're saying that's not the case. I'm wondering if I could get your thoughts on why that projection changed over the last year. It also tied in with this idea of government spending being at the upper bound, because just 3 months after that monetary policy report, the government tabled a budget that had $63 billion in additional spending, and then in the fall economic statement, another $20 billion. So I'd like your thoughts on whether those budgets interfered with the projection that you made in January of 2023.
Well, a couple of points. If you go back to the start of last year, I mean, we were forecasting inflation would be around 3% last summer. And then from there, it would go gradually back down. So the first part, actually, that projection proved to be pretty accurate. Inflation was 2.8% in June. What happened since then? Well, it's a combination of a lot of things. The first thing is oil prices went back up. You saw inflation went. That was the main factor that put inflation from 2.8 back up to 4. And the second thing I think we've seen is there has been more persistence in core inflation, underlying inflation. Core inflation has been running around 3.5% for 6 months to a year now.
Just because I have such limited time, I apologize, Governor. I guess really, to be more specific, was the increased government spending in the budget and the fall economic statement last year a factor in inflation not meeting the projection that you said?
So if you look at government spending at all levels in 2023, it's roughly growing at about 2%. So it's not helping relieve inflationary pressures, but it's growing roughly in line with the economy's potential population growth. So it's not adding new ones.
Fair enough. So during the press conference, you said, just quoting you, you said that, this is the press conference last week, government spending is at the upper bound of what's manageable, and that if governments were to add more spending on top of what they have already planned, it certainly could start getting in the way. And you stand by that statement today, I presume, right?
Yes.
So if the government's going to table a budget in a couple months, if you see large spending increases, would that make your job more difficult?
If there are large spending increases, yes, that could start getting in the way of getting inflation back down to target on the timeline we've laid out. We would have to look at, not all spending has the same effects on inflation, so we'd have to look at exactly what the spending is, and particularly spending that really stimulates demand at a time when we're trying to let supply catch up with demand and relieve inflationary pressures would be particularly problematic.
And I want to ask you the corollary of that. Let's say that some miracle happened and this government decided to become fiscally responsible and brought in a plan to bring the budget back into balance, actually got its spending under control in the upcoming budget. And in fact, the spending increases weren't just in the upper bound, but maybe even in the mid bound or the lower bound, as you might define that. Would that make your job easier?
If government spending turns out to be slower than we expected, yes, there'll be less demand pressures from government, and that means the economy growth will probably be lower, the unemployment rate will be a bit higher, and inflation will come down a bit sooner.
Those are my questions, Mr. Chair.
Morantz. And now we're going to hear from MP Thompson, please.
Thank you, and thank you for being here today. I wanted to just ask a question on climate change. I come from the East Coast, and clearly sea levels and rising temperatures and extreme weather events are very significant in my area of the country, and I think certainly we've seen across the country. When we speak about the increased costs for Canadians, like food and shelter, do we not also need to include the impact of climate change? And one example of that is the carbon pricing, which is really intended to help combat our net emissions and bring us to the intended targets. An analysis from Stats Canada published last November linked droughts, heat waves, flooding, heavy rainfalls with increased food prices, so meat, fruit, vegetables, sugar, coffee. In June, an economist from RBC reported that while food price inflation was expected to slow, a return to pre-pandemic levels were unlikely due to extreme weather events. So it was the link with weather and food costs. And being that the extreme weather events are certainly predicted to be more frequent. So are the costs of climate change included in your analysis of risks to the inflation outlook?
Okay. Well, it's a difficult question to answer. We are certainly, so let me just get back up to the first part. I would agree that, and we're already seeing it, the more you have climate events, one of the places that'll show up most directly is in food prices. And we're already seeing, we've seen more volatility in food prices. We're seeing more variability in harvests depending on what the weather is in different parts of the world. And so that is causing more volatility in food prices. And that's probably not going to go away. So we do not really have climate effects built into our main models at the moment. We have done some work, and Senior Deputy Governor was closer to this, looking at the potential financial stability implications of climate change. If there's a big repricing of assets, how would that affect the financial system? We are now starting to work on building climate change into our main macro model so we can start to evaluate those types of questions. I have to say this is a large undertaking. We are putting our heads together with other major central banks on how to do this. But in a world where there is potential for more supply disruptions, that is something that we're going to need to understand. Monetary policy has neither the mandate nor the tools to address climate change, but it is going to be a major force in the economy, and so we're going to have to understand what that means for the economy and what it means for inflation.
Thank you. I just wanted to just go back to an earlier question on the soft landing. Do you feel that the actions you've taken through the Bank of Canada on the economy have led to a soft landing and avoided a recession?
Well, so far we've avoided a recession. I will say, growth has been weak. We've actually needed that weak growth to let supply catch up with demand. But, we're very aware it doesn't feel very good. And as one of the previous members indicated, on a per capita basis, consumption is actually down. So, Canadians are really feeling this. And, all I can say is that having let supply catch up with demand, that is relieving price pressures, and that has brought inflation a long way down.
Thank you. And just seeing on the same point, you look at how far we've come since the COVID-19 pandemic. Do you feel indeed that we've reached that soft landing?
As I say, so far, yes, we have not had a recession. We don't think we need a recession. Our own forecast doesn't have a recession. It has what many people would call a soft landing. And certainly, we hope to see that, we don't have a recession. And certainly as you get to later next year, we expect to see growth picking up.
MP Thompson, and Governor, members, we are moving into our third round. I'm just looking at the time. We just have enough time, so we are going to have to hold a little tighter now on the timing. So we're starting with the Conservatives, and MP Scheer, please, for 5 minutes.
Thanks very much. Thanks very much for coming. In the previous few years, the Bank of Canada purchased hundreds of billions of dollars of government bonds at what were then low interest rates. And now interest rates have gone up. In your previous appearance before the committee, we talked about how that would put the Bank of Canada itself in a deficit position as it has to pay out more in interest than it receives on those bonds as those interest rates have gone up. Can you update the committee as to the budgetary position of the Bank of Canada in terms of a surplus or deficit based on those bond holdings?
Yes, I think the Senior Deputy Governor's got the numbers right in front of her, so I'll turn it to her.
So you're looking for bottom line losses? Is that what you're asking?
How much are taxpayers on the hook for the losses at the Bank of Canada?
Our losses or our profits always roll up into the government's overall financial situation. Our losses are very much contingent on the path for interest rates, I think, as you know. So, I mean, we are estimating probably somewhere in the range of ultimately $6 billion at the end. So, as I said, very much contingent on interest rates. We do have legislation that's been passed now that lets us retain our earnings. Normally, at the end of every year, we would have remitted whatever our earnings were to the government, and once the assets that you described roll off our balance sheets, we will be back in positive earnings, and that will fill that sort of overall loss, and then we'll be back to remitting to government. We expect to be back in a positive situation in about 2 years, and then we would continue remitting back to government.
So just to clarify, did you say it was a $6 billion loss? Total.
Yeah.
So the Bank of Canada is losing $6 billion. Your point about rolling that into taking advantage of the new legislation that allows you to retain earnings, it still does have the effect that the bank will not be remitting, I guess, dividends, for lack of a better word, to the government. So that there still is a cost to the taxpayer.
Yeah, on a temporary basis. I mean, prior to the quantitative easing, we would turn about a $2 billion surplus a year over to government, and we will get back there eventually. So, but there's a temporary period of time where we have losses that will roll up, and we expect to be back to remitting to the government in a positive situation.
Okay. So I guess if you normally remitted about $2 billion a year and you're going to lose $6 billion this year, that's an $8 billion swing.
That was a total, but yeah, sure, yeah.
Yeah. And if interest rates stay high, it could keep the bank in a deficit position for longer?
Yeah, as I said, the loss is always an estimate because it's based on the yield on our bond portfolio, so it's sensitive to interest rates.
That portfolio is government bonds?
Yes, primarily.
Not much of a portfolio in the traditional sense. It's just one kind of holding. It's one type of holding.
One issuer, yeah.
Yeah. And if interest rates go up, do you have a contingency plan? Have you done any estimations if you do have to raise interest rates, what that might do to your bond holdings and the deficit position?
I mean, we run a sensitivity analysis regularly. So our finance team is quite separate from our policy setting team. Will, like any organization, will run a sensitivity analysis on our portfolio.
Okay, thanks very much for that explanation. Mr. Macklem, you've talked before about government economic policy or fiscal policy, I think you call it, going at cross purposes on monetary policy. We've seen in the last few months of the year where the government's deficits over the last couple of years, the deficits have been much higher as the year closes out than originally anticipated. If that happens again, what impact will that have on your ability to lower interest rates in the short or medium term?
Well, I can't really add much more than what I've already said. I think we've built the government's spending plans into our forecast. If governments at all levels, federal, provincial, municipal, if they add a lot more spending relative to what we've built in, yes, that is going to make it harder to get inflation back down.
Yeah.
And now to MP Weiler, please.
Thank you, Mr. Chair. And I want to thank Governor and Deputy Governor for appearing on our committee again. I want to pick up on a line of questioning from Mr. Morantz earlier, and you mentioned that you made the point that not all government spending is considered the same in terms of the impact on inflation. And I was wondering if you could comment on things that government spending that might actually speed up the supply of housing, whether that's directly investing in non-market housing, or investing in programs that work with municipalities that allow them to speed up the permitting and zoning and delivery of housing, and if that would be inflationary or disinflationary?
Yeah, look, we're not housing policy experts, and I can't really add much more than what I said before. I think policies, and you mentioned a couple things that improve supply will be particularly helpful in the current situation. Yes, I think to some extent that does get speeding up permitting, taking some of the uncertainty out of the process, making it more predictable. I mean, the other thing we've seen, if you look at the actual construction of houses, time to completion has been going up. That's partly regulatory, it's partly industry practices. I think things that can get the time to completion to go down, shorten the time between a permit and a start, and then shorten the time to completion, we can get more houses through the pipeline. But I'm going to leave it to experts on housing policy to figure out what is the most effective way to do that.
Thank you. And I was wondering if you might be able to share the numbers with this committee, the overall inflation numbers, if you remove the inflation we're seeing in shelter costs right now, and just be able to comment, because this is obviously, you've spoken to the supply shortage right now and the limited impact on raising interest rates on being able to address that, and how that factors into your decision making on monetary policy going forward.
Well, if you just want a number, if you take CPI X shelter, it's going up at 2.4%. So you can see that shelter is making a big contribution to, currently inflation is 3.4%, so it's making a sizable contribution. In terms of our policy, though, I would emphasize a couple of things. First of all, Canadians are paying shelter costs. They're a real cost. I don't need to tell you, you're even more aware than I am. It's really having an effect on Canadians. So we can't just ignore them. This is really affecting Canadians. The second thing is, even if you strip out shelter costs and you look at the rest of inflation, there's still shelter is not the only source of underlying inflationary pressures. One way to look at that is, the number I gave you is, shelter is the biggest thing that's contributing on the upside, but there are also some things that are unusually weak on the downside. And so if you use a more systematic approach to strip out the ups and the unusual ups and the unusual downs, inflation looks to be about 3.5%. If you look at our core measures, trim CPI, CPI median 3.6, 3.7, CPI ex food and energy, a very simple way to strip out some of the big movers, it's 3.4. So what that's telling you is, the sort of center of the distribution is still above 3. Another way to look at that is if you look at the number of components of the CPI that are rising faster than 3%, that's still over 50%. So more than 50% of the basket is still rising higher than 50%. Normally, that number's quite a bit lower. So shelter costs are an important factor, but they're not the only factor.
And Governor, yesterday Statistics Canada released a flash estimate that showed that real GDP increased 1.2% annualized in December, which does suggest some strong momentum heading into this year. And I was hoping you might be able to comment on those figures and just the overall resilience of the Canadian economy.
Well, I'm always hesitant to react to one number because economies, you got to look at a lot of numbers to put it all together. But in our monetary policy report, which we published before that number came out, we expected Q4 GDP would be roughly zero growth. That number by itself would suggest November was 0.2, and the flash for December, which Statistics Canada would caution you, it's a flash estimate. It's not a hard number. They've got more data coming in, but you take those at face value, it suggests something bigger than, probably stronger than zero for the fourth quarter. I still think the fourth quarter is going to be a fairly weak number, certainly well below potential output growth.
MP Sainte-Marie.
Merci, Monsieur le Président.
Mr. Chair, at the beginning of the year, you did a lot of liquidity injections, and when was the last time that you used that tool? We know that it's a normal tool that you use. It's not used often, but why were the market's interest rates why weren't they not at the estimated level? What happened? And so in 2 minutes. It's complicated to answer that in French, but I will try it. I'll try to do this in French because we have 2 languages in Canada, and they're important. So just to answer your question, yes, in January, there were 12 days in a month where we conducted repo operations. Now, the amount was not the same every day, but it was probably around $5 billion. But that's a one-day loan, so after 1 day it's paid back. You can't accumulate that $5 billion. And then on the last day that we did was January 23rd, I believe. So a week ago. During the last week, we didn't do repo operations. So I just want to point out a few things. Those repo operations are routine operations. They're standard. They do not reflect problems of financial stability. They do not indicate systemic problems. But there's a certain friction. So from time to time we have to go and use those operations. And why do we do them? Well, it's because when we take monetary policy decisions, we set a target. And our current target is 5%. So when there is pressure, now there were increasing pressures. So our average overnight, those rates were going up higher than we wanted to see them. So there are operations that we use from time to time. Sometimes we do reverse repos, and we take deposits, not loans. Those involve deposits, not loans, rather, and that draws liquidities from the system. So I think I've answered your question. Thank you. Thank you, Mr. Sainte-Marie.
So I have 2 questions. The first, I hope you may be able to answer just in follow-up to the committee. I doubt that you'll have the answer today. And the second, I hope to get your comment on today. So the first, New Democrats support carbon pricing in some way, shape, or form. Don't always agree with the government on exactly how they're doing it. But we have proposed to remove the GST on home heating. Now, you've been able to calculate what the one-time effect on inflation would be of removing the carbon tax. Wondering if you might be able to calculate what the one-time effect of removing GST on home heating would be. We prefer that option because it applies to all Canadians, including ones who use renewable energy in order to heat their home, like hydroelectricity, for example, we prefer that approach because it applies in all parts of the country. As you know, the federal carbon price only applies in some parts of the country and not others, like British Columbia, for example. So eliminating the carbon tax on home heating doesn't do anything for Canadians who are living in provinces with their own carbon tax regime. So that's why we prefer the GST approach, and I would be very curious to get the bank's opinion on what the inflationary effect of removing GST from home heating on all forms of home heating would in fact be, and then we could have a bit of a comparison in terms of that approach. And to Mr. Lawrence's point, because the GST is applied on the carbon tax, it would also have a mitigating effect on the carbon price increases going forward, albeit it wouldn't completely eliminate them. So if you might be able to return to the committee in writing on that point, that would be very much appreciated. The second question has to do with the climate change discussion that was had earlier. Canada is notoriously behind some of our trading partners, particularly in Europe, but I think also arguably the Americans, on having a taxonomy for classifying various kinds of green investment and for having a requirement for publicly disclosed corporate transition plans. So I wonder if you could speak to the utility of having those publicly disclosed plans required of Canadian companies and having a clear established taxonomy for the bank to be able to do the work that you were talking about in terms of trying to better incorporate climate effects into your own forecasting.
Well, look, the climate policy taxonomy are really, in the realm of elected officials. I look, as a general comment, I think, disclosure, having agreed upon sort of rules of the road, a taxonomy, so that people can agree on, okay, what this is relative to that. I think those are useful bits of infrastructure that would, allow people to make more informed decisions, allow for more informed investment decisions. So I do think those things would generally be helpful, yes.
Thank you, MP Blakey. And now we're going to MP Chambers, please.
Thank you very much, Mr. Chair. Welcome back to the committee. It's always nice to have you here. I think we've exhausted the spending discussion a little bit. But there's two ways that government can affect demand. One was through spending, and we've gone there. The other is through population growth. We haven't talked about that. But I know it's becoming more of a theme in the monetary policy report. The last couple have definitely singled out population growth. Would you say that population growth is significantly adding to demand and as well making your job difficult?
Well, I'd make 2 points. Undoubtedly, population growth is significantly adding to demand. It's also significantly adding to supply. We can see, so I'll start with supply. You can see this very clearly in the labor market with a large number of newcomers. That has helped to ease the pressures in our labor market. Our labor market was very overheated. It's now in much better balance. And in fact, you can, I think it was in a previous monetary policy report, we had a chart that linked the sectors where there's been the most immigration are also sectors where you've seen the most rapid rebalancing of the labor market. So there's clearly a link there. Equally, there's clearly a link on the demand side. And there, what our analysis tends to indicate is for consumption more broadly, not shelter, that's separate, but for consumption more broadly, the economy's done a pretty good job of absorbing that demand. There's enough flexibility in supply that obviously you have more people, you got more consumers, you got more shoppers, but there's been enough flexibility in supply to really accommodate that, and it hasn't had material inflationary consequences. Shelter, on the other hand, is a different story, and we've already talked about that. We've had a long period in Canada where the supply of shelter, demand for shelter has been growing faster than supply, and with the acceleration in immigration, or it's actually both permanent and non-permanent residents, that has further increased the demand. And supply was already not keeping up, so there hasn't been the flexibility on
Appreciate
supply.
that. So I'm just
So
gonna
it is
jump-
boosting
Thank you very
shelter
much. So I'm just
costs,
gonna jump
and that's
in there.
showing up in inflation.
Population growth, government spending, risks. I note that aren't appear in your risk to the framework, or risk to the projections. I think Canadians are curious as whether policymakers are actually thinking about these things, and I'll explore this with you at another date. But is the Senior Advisory Committee actually functioning well? There's not a lot of transparency. I mean, the bank's now talking about these items out in public. Like, have you been able to raise these items closed door appropriately to flag the vulnerabilities for the government?
We do, the Senior Advisory Committee, for those of you who don't know, happen to know what it is, it's a committee of the...
I have a lot of time. Let's
Yep.
assume they know.
Okay.
I don't have a lot of time.
So yes, we have been discussing these issues. From time to time, we invite CMHC to participate in the discussions, given that they are the principal Crown Corporation responsible for in the housing domain. So yes, those discussions are happening. I mean, I'm not going to speak for the government, but you saw last week the cap on students.
I appreciate.
So
I appreciate
I think
that.
there is a level of awareness.
Thank you very much. Also, first, before I turn it back over to you, last question. I'll apologize on behalf of all of Parliament for not listening to you 2 years ago when you came here and said, half jokingly, to stop spending. But I think that was very forward-looking of yourself. But we didn't deliver. Parliament increased spending by over 25% versus pre-COVID levels, and we haven't done our job. We haven't done our job on spending. We haven't done our job on population growth. So last question in the last 30 seconds. There's an election coming up. Could be in a couple months, could be in 2 years. Every political party, very rare for a politician not to resist the temptation to buy votes. Also rare for voters not to want to take that. What advice would you have for those seeking to buy votes in the next election?
Well, the one thing I never do is give political advice, so I'm not going to break that rule now.
It's going to affect inflation. It's going to affect inflation, right?
I'm sorry, I don't give political advice.
MP Chambers, and that's a good rule. That is a good rule. So we are moving on to our last questioner. That's going to be MP Baker for the governor, Senior Deputy Governor.
Thank you, Chair, and thank you again, Governor and Senior Deputy Governor, for being here. I have a few questions, so I hope we can get them all in. I'd like to come back to something one of the other members raised, and I just want to ask you for clarification, Governor. My understanding is that the overnight repo operations are normal functions of monetary policy, and I wanted to ask you to confirm whether that's correct. And can you just briefly explain how your other international counterparts, like the Fed in the U.S. or the European Central Bank, et cetera, how they use this tool of monetary policy?
Yes, you're right. Overnight repos are sort of a standard part of our operating framework. We haven't used them for some time because, really the pandemic sort of interrupted that because there was a number of extraordinary tools used. But now things are getting back more to normal, and so you're seeing us using this tool again. As you suggested, we're not. So we are seeing some tightness in overnight markets. There's probably more than one reason for that, but one factor, which I think is a more global factor, and we have been talking to other central banks, and they are seeing similar types of pressures. One thing you're seeing is, as you're well aware, bond rates went up quite a bit in the last couple of years. More recently, they've started to come down as market participants expect that central banks, we're winning the fight against inflation, so they're expecting we will lower interest rates. And that is spurring increased demand for those bonds because they want to buy them before interest rates come down further. That has to be funded. Some of that funding is in the overnight market, so it's creating some upward pressure. And as I responded to the previous question, so we have been using overnight repos to keep the actual overnight rate in the market very close to our target overnight rate, which is the rate we decide on when we take monetary policy decisions. So really this is about, it's simply about implementing the monetary policy that's intended.
Thank you very much.
And just maybe in follow-up to your question, I was on a call with our colleagues from other central banks on Monday this week, and I was actually at the Fed on Tuesday, and what we're seeing happen in Canada is happening at other central banks. They're also using the equivalent to their tool, the overnight rate, for largely the same reasons that the governor described. So.
That's very helpful. Thank you both for that. I have about 2 minutes left, if I'm not mistaken. There's been a lot of discussion here about what's contributing to inflation, the cause of inflation. And most of the discussion here has been focused, or a number of members have asked questions or suggested that it's, that it's the government's fault. The decision the government has made have unduly contributed to inflation. We've had a discussion about the government spending, and earlier in my questioning, you answered the question, Governor, about the fact that if we're close to that 2% growth in spending, that we're not unduly contributing to inflation. But I wanted to ask you the question that a lot of my constituents also ask me, which is, what is causing inflation? Last time you were here, I asked you about that. We talked about things like global supply shocks. We talked about the war in Ukraine and its impact on energy prices and food prices. Could you just explain, again, for the sake of my constituents, but also for clarification here amongst the MPs, what are the major reasons that we have high inflation, and not just in Canada, but in many countries around the world?
I could go on for a long time, but I know I don't have a lot of time, so I'm going to keep this brief. The big burst of inflation that we saw in 2022, up 8%, it really started largely as a result of global factors. Global demand for goods was very strong. People couldn't get the services because of COVID. They couldn't go to the gym. So they bought gym equipment. All those goods had to be produced, shipped, at the same time that the supply chain was still really gummed up because of COVID. Russia's unprovoked attack of Ukraine further increased oil prices and food prices. So the beginning part, it was largely more global factors. Those have actually come off significantly. The second factor, though, is as the economy reopened from COVID, Canadians really, and this isn't unique to Canadians, people everywhere, they wanted to catch up on all the things they'd missed out. And so they wanted to go to restaurants, they wanted to take holidays, and companies just simply could not keep up with demand. They couldn't hire people fast enough, and so we got a big burst of more domestically created inflation. That's, now the inflation is more domestic and less global. We've raised rates forcefully. That has slowed the economy. And to come back to where I started, it's working. Demand has slowed, supply has caught up. That has increased our confidence that we've raised rates enough to get us back to 2% inflation. And once we get more assurance that we're on that path back to 2% inflation, we can start thinking about cutting interest rates. But we're not there yet.
Thank you very much.
Thank you, and thank you for that. Paints a great picture. Thank you, MP Baker, Governor Macklem, Senior Deputy Governor Rogers, for answering the many questions on monetary policy, smartly not answering some of the other questions that were not directed to monetary policy, but we really appreciate you coming in here at the start of the year. And we're all hoping for a much better 2024 than 2023. And I know Canadians are waiting to hear your next report as to address inflation as well as interest rates. Thank you. And on that, members, we are adjourned.
Thank you.
Always a pleasure.